Welcome to the accounting desk, where clarity meets precision. Have you ever pondered how events after the reporting date influence public sector financial statements? Today, we journey into the essential world of IPSAS 14. In the next 10 minutes, you will gain insight, clarity, and confidence in handling events that occur after your reporting period. Stick with us as we unravel these complexities and show you real-life examples from the public sector. Let's embark on this enlightening exploration together. The objective of IPSAS 14 is clear and focused. It prescribes when financial statements should be adjusted and details the necessary disclosures for events occurring after the reporting date. This standard is not just a set of guidelines, it is a vital tool that ensures the accuracy and fairness of financial reporting. It is designed to protect the integrity of financial statements, offering a complete and transparent view of an entity's financial position. In a field where precision matters, understanding these principles is crucial. With the right knowledge, you can navigate the complexities of post-reporting events confidently. The scope of IPSAS 14 spans all entities that prepare general-purpose financial statements on an accrual basis under IPSAS. However, there is a key boundary to note. It excludes information received after the financial statements are authorized for issue. This clear demarcation serves as a protective barrier, ensuring that only relevant and timely information influences the financial narrative. In short, IPSAS 14 guides how early or late events should be handled, ensuring consistency and fairness. Let us now turn our focus to a core concept in IPSAS 14, the reporting date. This is the endpoint of a reporting period, and in many cases, it is December 31st. This critical date marks the point until which all events must be collated for accurate financial representation. Events that occur after this date, but before the financial statements are authorized for issue, remain significant. They could hold the key to understanding underlying financial conditions. This reporting date serves as an invisible line, a boundary that differentiates past certainty from future possibility. In order to understand IPSAS 14, we must delve into two distinct types of events: adjusting events and non-adjusting events. Adjusting events are those which provide clear evidence of conditions that existed at the reporting date. These events require that any mistakes or misestimations be corrected in the financial statements. For example, consider a court case settled just after year-end. The conditions leading to the liability were already in place on the reporting date, and so the financial statements must reflect this reality. Another example could be the bankruptcy of a customer whose financial difficulties were evident at year-end. Even the discovery of errors or fraud that took root during the reporting period falls into this category. To put it simply, if the event confirms a condition that already existed, adjustments are necessary. On the other hand, non-adjusting events are those that indicate conditions arising after the reporting date. They are a glimpse into what happens next, rather than a rewriting of the past. A major natural disaster striking after year-end or an announcement of restructuring are classic examples. Non-adjusting events highlight future risks or unanticipated challenges. One might even think of a bond issuance after the reporting date or the unfortunate destruction of an asset by fire. Although these events are significant, they do not alter the figures recorded at the reporting date. Instead, they require careful disclosure in the accompanying notes of the financial statements. At times, the complexities of these classifications can seem overwhelming. The challenge lies in discerning which events have roots in past conditions and which represent new developments. This is a critical distinction that not only affects the numbers on the balance sheet, but also impacts the trust stakeholders have in the reported financial information. This understanding is vital for public sector financial professionals, accounting students, and every individual keen to master financial reporting standards. It transforms abstract principles into tangible decisions that affect everyday financial transparency. Let's take a moment to visualize these concepts with a clear and engaging comparison. Imagine a side-by-side table. On one side, you see the adjusting events, court settlements, customer bankruptcies, and identified errors. On the opposite side, non-adjusting events such as natural disasters, restructuring announcements, bond issuances, and asset destructions. This visual separation reinforces the idea that while both types of events are important, they play very different roles in financial reporting. The adjusting events reshape the numbers, whereas non-adjusting events prompt transparent disclosures that inform readers about potential future impacts. As we move forward, consider the power of public sector examples. Real-life scenarios help to bring theory into practice. Picture a vibrant public hospital that discovers in January that a significant lawsuit, precipitated by incidents apparent at year-end, will cost $1.5 million. This is a textbook example of an adjusting event because the underlying condition existed at the reporting date, and therefore the financial reports must reflect that liability. Now shift your focus to a large public warehouse managed by the Ministry of Education. Imagine a fire breaks out on January 10th, destroying the premises. Although the event is dramatic and has serious ramifications, it is categorized as non-adjusting because it occurred after the reporting date. Here, the focus is on disclosing the event rather than adjusting the financial figures. These real-life instances underscore the importance of applying IPSAS 14's classifications accurately. The journey does not end at understanding classification alone. Equally critical is the treatment of these events in the public sector's financial documents. When it comes to non-adjusting events, the obligation to disclose is paramount. Entities must provide clear details regarding the nature of the event. They are also expected to supply an estimate of its financial effect wherever possible, or at least state that an estimate cannot be made. Let's consider a case. On January 5, 2025, a public entity experiences a significant loss of assets due to flooding. The financial report would note that a $3 million asset loss occurred, make clear that this event happened post-reporting date, and emphasize that it has not been recognized within the primary financial figures. These disclosures empower stakeholders with a complete picture, ensuring that decisions are made on the basis of full, unambiguous information. An equally critical piece of the puzzle is the disclosure of the date of financial statement authorization. This date signals when the financial information is finalized. It establishes the definitive cutoff for considering and including post-reporting events. Knowing who authorized these statements and when is a matter of transparency that bolsters confidence in the reported figures. It is a simple, yet potent control mechanism that assures users about the reliability of the financial statements. Now let's pause and take a few moments to recap the vital points we have explored. First, IPSAS 14 guides us through the treatment of events occurring after the reporting date with precision and clarity. It distinguishes between adjusting events, which reflect conditions present at the reporting date, and non-adjusting events, which emerge subsequently. We learn through concrete examples how adjusting events, such as court settlements or customer bankruptcies, necessitate adjustments in the financial statements. At the same time, non-adjusting events, like natural disasters or restructuring announcements, demand thorough disclosure in the notes section, ensuring complete transparency. This clear delineation simplifies what might otherwise be a confusing landscape of financial data adjustments and disclosures. By following these principles, public sector entities can offer financial statements that are both accurate and insightful. The ultimate goal is to provide a financial picture that speaks truth to data, reinforcing trust and accountability in financial reporting. Every element in IPSAS 14 works together to preserve the integrity of financial information against the backdrop of post-reporting events. It transforms potential chaos into a structured, comprehensible narrative. Understanding IPSAS 14 is not simply an academic exercise. Instead, it is a pragmatic approach to financial stewardship that has immediate, real-world applications. In the fast-paced world of public sector financial management, unforeseen events can have profound impacts. Whether it's a sudden natural disaster or an unexpected legal settlement, knowing how to correctly reflect these events in your financial statements is crucial. It is this knowledge that equips financial professionals and accounting students with the tools they need to maintain high standards of transparency and accountability. Imagine the confidence that comes from knowing that your financial reports accurately represent all material events. This confidence is well-founded when you apply IPSAS 14 diligently. Each adjustment, Each disclosure contributes to a greater trust from stakeholders and ensures that financial decisions are grounded in reality. This level of assurance is what makes IPSAS 14 an indispensable part of public sector financial reporting. It bridges the gap between complex events and clear, understandable financial statements. As we near the end of our discussion, let's briefly re-emphasize the essential message. Always distinguish between events that affect historical conditions and those that signal new developments. This distinction is the very heart of IPSAS 14. By adjusting numbers for events that confirm pre-existing conditions and disclosing those that arise subsequently, you create a financial report that is both rigorous and transparent. Each step along this learning journey has been designed to empower you with the tools required in today's accounting landscape. Whether you are a seasoned financial professional or a student learning the nuances of IPSAS standards, the principles of IPSAS 14 serve as a foundational guide. They remind us that accurate financial reporting is not merely about numbers, but about conveying the narrative behind those numbers with clarity and honesty. With a clear understanding of IPSAS 14, you are now better equipped to handle the diverse challenges that can impact financial statements in the public sector. Remember, every event after the reporting date holds the potential to either adjust or simply inform the financial world. Embrace this knowledge and let it guide you in crafting financial statements that are truly reflective of the underlying economic realities. Thank you for joining us on this deep dive into IPSAS 14, events after the reporting date. Your commitment to learning and excellence in financial reporting is commendable. If this session has helped clarify your understanding and improved your confidence in navigating post-reporting events, please like and subscribe for more IPSAS walkthroughs. Stay tuned for our next deep dive into IPSAS 16, investment property. Keep striving for clarity and transparency in every financial statement you prepare. Your dedication to precision makes all the difference. See you in the next lecture.